Hi, I'm Eric Burkholder, Senior Advisor and Founder of Burkholder Wealth Management, here with Jordan Bradford, Senior Advisor at Burkholder Wealth Management. And today we are doing a video to talk about big news this week, which was the Fed announcement. So, Jordan, why don't you kick us off? Tell us what the big news was this week and what happened.
Yeah, probably one of the more highly anticipated Fed Reserve meetings, certainly within the last couple of years. It's the first time that the Fed has cut rates since about March of 2020. So it's been a while since we have seen the Fed start to actually lower interest rates. Of course, in the last handful of years, we've seen rates climb quite a bit to combat inflation. But just yesterday, the Federal Reserve met in Jackson Hole, Wyoming, where they always meet, and they decided to cut rates by 0.5% or half of a point, 50 basis points, however you want to refer to it. But it was a big cut, certainly larger than I think what a lot of people expected, over the course of the last couple of months. But as we started approaching the actual day, I think the market started pricing in a little higher expected rate cut, which is what we ended up getting right at about 0.5%. The Fed's target range right now is about 4.75 to 5 currently, and it looks like they're aiming for a goal of somewhere around 4.4%, which would put them in the 4.25 to 4.5 range as an end goal by the end of the year. Certainly a lot of news that came out of the Fed meeting in relation to the economy, inflation, and it sounds, all of it sounds pretty good, I would say.
Right. Yeah. I think in contrast to a lot of your, historical rate cuts, we often seem to correlate rate cuts to deteriorating economic conditions. And I think it's important in this situation to realize that we're not in that scenario. The reason why the Fed had held rates above their long-term target rate was because of inflation. And now that inflation has moderated significantly from the post-pandemic world, and the last inflation print was 2.5%, still above the Fed's target of 2, but they anticipate it continuing to go down when we get the August numbers. They're cutting rates for good reasons in this scenario, where often they are cutting in response to deteriorating economic environment. Yeah, I mean, it really is good news. It's like you said, it's a large cut, and they actually project to continue to cut more. Ultimately, their target is closer to that 2.5% rate, and so it's not a good idea to bet on the direction of interest rates, as we've seen the last few years. But certainly, the goal is to continue to cut. So I think that's going to bring a lot of relief to certainly people who are taking out mortgages and things like that. And so overall, very good news.
Yeah. Yeah, I think that when you look at all the indicators that are out there, and Powell touched on a lot of these in his post meeting press conference, where he detailed kind of the explanation for why the rate cut, why the amount, what they're seeing kind of moving forward. Powell mentioned unemployment, and we're currently basically running at near maximum employment. So the Fed's trying to thread a needle right now of, cooling off the inflationary period that we've been in without sending us into a recession, just slashing rates all the way back down to zero, which I think is also a good point to make, is that, Powell also said that we're probably not going to see rates back, in those ultra low levels again. Never say never. And I'm sure at some point in our lives, we'll see rates, low again. But, I think that the Fed is really hoping and trying to make it a pretty soft landing, where we don't have to go back to a period where you can't earn anything in your savings account. Yes, you might be able to get a 30-year mortgage for 2.75%, but if you can't earn anything in savings, that's not a healthy economy. we need to have a little bit of give and take, and I think that's what the Fed is attempting to do here. And inflation has been coming down. Now, there's a lot of like misnomers out there as to what that really means. It does not mean that the cost of groceries are coming down. It just means the rate in which they're increasing in price is coming down. I think that's a pretty important distinction, because I do think that gets missed sometimes when people hear that, oh, inflation is down, and they go to the grocery store and they're like, I don't think it's down. It's still more expensive than it was a couple months ago or a year ago or 2 years ago. And it will be. And that is what inflation is that over time, it stacks on top of each other. So we need to get inflation back down to reasonable levels, because 2% increases year over year is healthy and sustainable. 8-9% inflation is not. And so I think that the Fed, did a pretty good job up to this point, at least, because they have not pushed us into a recession when they were raising rates, and they're doing what they think is the right course of action to lower rates without also then pushing us back into a potential recession. It is a challenging task that the Federal Reserve has, because they don't have a lot of tools in their tool belt. They can pretty much raise rates, decrease rates, and they can do a little bit of, monetary tightening. But outside of, some very few opportunities they have to actually impact what's going on with inflation in the economy, a lot of it is outside of the Fed's control. So, imagine, you're doing your job anywhere and you only have two things that you can do to affect your job. It's going to be difficult to perform really well all the time. So I think the Fed's done a pretty good job, all things considered. But you alluded to it a little bit, that we shouldn't expect or bet on maybe the direction that the Fed might be headed. But the Fed did kind of say that they want to continue to lower rates at least a little bit here before year end. And they've got meetings coming up in November and December. Do you have any speculation as to, maybe what investors should be thinking might happen?
Yeah, well, so the best information would go off of is what they say they think they'll do, but huge asterisk and grain of salt that they have not been anywhere close to their projections over the past few years. But they are saying another half a point, 0.5% before the end of the year, with potentially 1% next year, and then another half a percent the year after that, which would get them right at their eventual long-term target around 2.5 for the Fed funds rate. But as I've said, as we've seen, it's very hard to predict what will actually happen. But I think that's the preferred path that they would like. But it seems like things are going that way. Given employment looks strong, inflation is back into a very moderate range, and so I think that would be good for everybody. I think a question a lot of people's minds is, well, what does that mean for the market? What does that mean for mortgages? And unfortunately, the answer is it depends, or we don't know, because the Fed funds, and as you alluded to, Jordan, the Fed might not like to hear you say this, but they do have only a couple tools, and they don't control the market as much as they may wish they could. And so things like mortgages are also very dependent on supply and demand and market forces. The Fed funds rate plays into that, but it's not the only factor. And so it's the term, we look at the term structure of interest rates, the longer end, those 30-year term debt instruments, they might not move. They may move the opposite direction. They could always potentially still go up. While we think this will ultimately provide some relief for mortgages and people who are taking out long-term debt, that doesn't necessarily mean that right away that will happen. That's really more market dependent. The Fed can only control the short-term end of the rate structure. So that's one thing to keep in mind. But, we don't know where mortgages will go. And for the market, we don't know where the market will go. I mentioned earlier that typically rate cuts are correlated with market downturns, but that is a correlation, not a causation. Typically, we have a market that's already going down, an economy that's going down, and then you get a rate cut. In this situation, the market was starting, as you mentioned, Jordan, up, getting close to the announcement, was really pricing in that 0.5% cut, and so the market's all about expectations, right? The stock market specifically. the Fed funds rate is just one small piece of what affects the market. I would say the trend towards the things we mentioned, lower interest rates, lower inflation, a good unemployment numbers, those are all good for the market typically. But, again, we can't speculate because if you look at the data, there are many different market reactions to interest rate increases, decreases, increasing with good economies, increasing bad. All the combinations you look at, there's not a definitive pattern. But I think the big takeaway is things are moving in a direction that everyone should be happy with.
Yeah. Yeah, and I would just chime in with one last thing on this Fed rate cut, right? I've been asked a lot. Probably the biggest question I've been asked is, how is this going to impact my mortgage rate if I'm wanting to buy a house soon? And you alluded to the fact that it isn't a point for point system between a 30-year mortgage and the Fed funds rate. And what we've actually seen over the last year is the markets have already priced in rate cuts, because a year ago, the 30-year mortgage on average across the nation was around 8.1%, is what the high point was as an average. And as of basically today, or yesterday really, the average national 30-year fixed mortgage was right around 6.2%. And we hadn't seen any rate cuts during that time frame. That's a big drop off because we're seeing expectations of, okay, the Fed's not going to just continue to raise rates. They're going to eventually drop rates. And so we've already seen the 30-year mortgage have some reaction to that. And so I wouldn't expect that you can go to your banker tomorrow and ask them for, okay, what is the new 30-year mortgage rate? I assume it's going to be at least 50 basis points less than what it was a week ago. That's probably not going to be the case. You're probably going to find that it's going to be about the same. And I think what'll be a bigger deal is maybe by the end of next year. If the Fed does hit their targets of maybe dropping rates by another 0.5% this year, another 1% next year, if the Fed keeps continuing down that course, naturally I would expect to see mortgage rates come down a little bit further. But again, you're probably not going to see 1.5%. We might see that mortgage rates drop from 6.2 down to maybe 5.75 as and that might be where they kind of stop for a while unless we see rates go dramatically lower. So if I were talking to someone in the market for buying a home or selling their home, what I would tell you is that I would not be waiting for ultra low mortgages, because you might be waiting forever. You might be waiting for only a year. It's hard to tell. But I would say that the way the Fed has gone about this so far, the way the market has reacted to the Fed's decision making, would imply to me that you've probably seen a lot of the future expected rate decreases kind of built back in, and there'll be a little bit more. I would guess, but again, I would not be counting on the Fed to be dramatically decreasing the mortgage rates over the next 12 months. So that might not be great news for everybody, but we do want to sprinkle in a little bit of reality here, along with the good news of the economy pointing in the right direction with a lot of strong signs. So those signals that we're getting from the economy has been great. The Fed has basically acknowledged that, and that's one of the main driving factors why they decided to do 0.5% instead of 0.25%, was economic signals are stronger than expected. And I think if the Fed had a do-over, they probably would have lowered rates by 0.25% in their last meeting in July, and then would have dropped rates by 0.25% now here in September. But because they didn't do anything in July, economic data showed really strong. And so I think that they were kind of making up for lost time a little bit there.
Yeah. No, I agree with all those points. And, I think that, like we've just discussed, the big takeaway, this is a good sign for everybody, but how that plays out as far as markets and mortgages, it's not as clear cut. So it is good, but don't expect to, as Jordan said, magically get a lower interest rate, or, the market is up as we're filming this, but that does not mean it's going to be up, over the next month, 3 months, or a year. So overall, it is welcome for, I would say, almost everyone agrees this was a good time to cut rates, but how that plays out in your specific investments and debt is to be determined. And as always, we would say you have to make decisions based on your plan and what fits you personally, not on predicting what the Fed is going to do, how that affects rates or markets. Continue to focus on the plan that you've established and the investment strategy that you worked on, and don't be upset about the interest rates because it's a good thing, but just we might not know how that plays out. And so, it's always we want to stick to the plan that we've
Absolutely.
So that's all for today. Obviously, if anybody out there still has questions, we're always here to help answer, and we're happy to talk further. And if not, we will see you on the next video.
Thanks for listening.